You're with us here on Bazaar Open Exchange. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. And of course, we are counting down to the pre-open session, which is about 2 minutes away. I want to just take a quick look at the IT services pack. And there is some read-through maybe from what has happened overnight in the US. Not directly, but I think it warrants a quick mention. So there's a company called CDW, which reported earnings. I'll get to the company earnings in just a bit. But this is basically what stocks, US IT hardware stocks did last night. Look at that. Cisco was down 4.5%. HP was down 5%. A company called Pure Storage was down 6%. Anything between 3 and 6% cuts across the IT hardware space last night. Now, the trigger was that CDW, which is primarily a hardware company. I mean, they make everything basically: power adapters, screen guards, microprocessors, motherboards, but they also do services and they offer IT solutions as well. So primarily hardware, but also services and solutions. They came out with a pre-quarterly update and it was pretty disappointing. They are basically now saying that according to them, their assessment, overall US IT spending in 2023 is going to fall in the high single digits. Now, that's not great news, is it? That's their assessment. The previous assessment a couple of months back was that it'll be flat in 23 compared to 2022. The stock itself ended about 13.5%. And of course, I showed you the collateral damage we've seen elsewhere. Now, the read-through, as I said, is largely hardware. But, the fear is that the weakness is spreading out of hardware to software as well. Having said that, it is not as if we don't know that IT services itself is under a bit of pressure and there is a slowdown. There are concerns about spending, degrowth, etc. But I think this is one more thing which points to the fact that 23 perhaps will be a tough year for IT services spending, perhaps a rebound only next year. For stocks, the way to look at this is you got to ask whether this is a new signal, new demand weakness signal, or some of this is already in the price after what we've seen with Infosys, TCS, etc. Let me actually put this to Dipan quickly. Dipan, you did allude to this briefly to my question on Mastech, but any thoughts here?
No, I think that the bad news in the IT industry is just about starting to come. I think until about last quarter, all the managements were confident that they would sail through the economic headwinds in the key markets. But the picture certainly is getting ugly. And as I said earlier, I think this particular time we will see the men being separated from the boys. And if the companies which have got good clients, specific verticals, some IP, something special about them, they may continue to sustain growth rates. Some large project could be, but a vast majority of IT companies are going to find the environment very challenging. And you should factor in flattish to slightly declining earnings as well. And how long that could last is anybody's guess, because this entire inflation interest rate situation is not seeming to be ending in a hurry.
All right. Dipan, what about steel? Normally you stay away from these metal stocks in the past for the last many years that I have known you. But what's your view? I mean, some on the street believe that after that lull that we have seen, maybe some of these stocks are presenting an opportunity, though. You need to highlight that there are still plenty of uncertainties with regard to the globe, even for the European market with regard to Tata Steel. But would you look to buy any of them?
I think when you are buying commodities, you're basically trying to fight all the central bankers in the world who want to get inflation under control at any cost, be it even at the cost of slowing economies and tolerating some amount of unemployment. And if you're in that situation, then how can you expect commodity prices to rally or even sustain themselves, or that for that matter, volumes also to grow or even maintain the present levels? So I think it's a very challenging environment. You may have an odd good quarter or so, a new expansion plan going on stream, maybe higher volume here or there. But overall sentiment in commodities is going to be down. And even though these companies may report decent to slightly higher earnings, I expect next 3-4 quarters for them to see a compression of their price to earnings, price to book. And steel in specific is not really trading at underwater type of valuations, which it has done in the past, which make it extremely attractive. They are still at reasonable valuations. So keeping that in mind, I still want to avoid steel. It's better to go for the steel consumers, the real estate companies, the infrastructure companies, engineering, capital goods. I think they are in the best time of their life at this point of time, and that's where one should focus on.
Okay, all right. I do want your thoughts on the pharmaceutical space as well, because they've been a lot of big moves, right, in terms of individual stocks. And of course, we were just discussing that Mankind Pharma IPO too. But let's get